If I was starting to invest in 2024, here's exactly how I'd think about it. What I'd buy, how I'd buy it, and most importantly, why. None of this is financial advice. It's simply the way I approach investing and the lessons I've learned from studying what actually works. I've linked plenty of resources below to help you build your own plan. But let's start with the big question: what would I buy today? If you look back at what powered the markets in 2023, one theme dominated technology, the so-called Magnificent Seven. Meta, Apple, Nvidia, Microsoft, Amazon, Alphabet, and Tesla carried most of the growth. Over the last 5 years, companies like Tesla and Nvidia returned more than 700% to investors, while the S&P 500 as a whole rose around 23% in 2023. But here's the twist: if you removed those 7 giants, the rest of the market only gained about 6%. So it's tempting to think, why not just buy those 7? But history shows that what looks unstoppable rarely stays that way. If you check the top companies by market value over time, the list constantly changes. In 2003, Walmart and Exxon were leaders. In the 90s, Coca-Cola and General Electric dominated. Go back another decade and it's a completely different lineup. The point is simple: the biggest winners keep rotating. Betting on today's favorites might mean missing the next big thing tomorrow. Research backs this up. A study by Hendrik Bessembinder found that from 1926 to 2015, just 4% of all listed companies generated the entire net wealth created by the stock market. The rest either underperformed or disappeared altogether. Another analysis showed that only about 300 of the 500 companies in the S&P 500 in 1990 still existed a decade later. So picking the right individual stock isn't just hard, it's nearly impossible over the long run. That's why my approach is built around index funds. Instead of trying to pick winners, I buy the whole market at once. The S&P 500, for example, has averaged roughly 10% annual returns over the last century before inflation. Investing just a couple $100 a month at that rate for 40 years can grow into more than $1 million. You don't need to be lucky or a stock picking genius. You just need time, consistency, and patience. Even Warren Buffett, it says most investors are better off owning index funds rather than trying to beat them. Now, which index funds would I buy? That depends on what part of the market you want to track. There are funds that mirror the top 500 US companies, others that include every US stock, and some that cover the entire world. You can even choose global funds excluding specific regions like America or Europe. Personally, I like the simplicity of global funds because they automatically adapt as markets evolve. If you look at how global market share has shifted since the 1900s, it's striking. The UK once made up 25% of the world's stock market. Now it's around 4%. Japan dominated in the 80s, then America took over. Today, the US accounts for about 60% of global market value. But just as the Magnificent Seven might lose dominance, so could the US over time. Countries rise and fall, economies evolve, and new markets emerge. So rather than bet on one nation, I prefer to own them all through a diversified global index. The truth is, no one can predict what will perform best next year or even next month. but what we do know is that over decades, markets tend to rise. The key is staying invested long enough. If you'd invested in a global index for just a single day anytime since the 1970s, you had about a 50-50 chance of making money. Hold for a year and your odds jumped to 73%. Hold for 10 years and the chance of profit soared to over 90%. Time, not timing, is what builds wealth. Of course, before buying any investment, you need the right account. In the UK, that means using tax-efficient wrappers like ISA or pensions, which shield your profits from taxes. Too many people still invest through general accounts while leaving their ISA allowances unused. Personally, I'd always max out tax-free accounts before investing anywhere else. When it comes to platforms, there's no single best one. I use a few trusted brokers, and each year I review which ones offer the best combination of low fees, reliability, and user experience. I even maintain a public spreadsheet comparing popular global and US index funds available in the UK, along with a glossary explaining those confusing fund names. It's not financial advice, just a guide to help you understand what you're buying. But here's something important that often gets overlooked. Investing won't make you rich overnight. It's not a get-rich-quick scheme, it's a get-rich slowly plan. When I first learned about compounding, I thought it was the magic formula that would solve everything. But focusing too much on investments can distract you from the habits that actually increase your income. People often obsess over squeezing out an extra 1% return, but improving your career skills, starting a side hustle, or earning more each month has a far bigger impact. For example, investing £200 a month for 30 years at 10% gives you around £450,000. Increase your return to 12% and you get about £700,000. Nice, but not life-changing. Now double your monthly investment to £400 by earning more, and you end up with roughly £900,000. The lesson: focus on growing your income in real life, then let investing quietly compound your efforts in the background. That's why I believe investing should be boring. I buy low-cost global index funds through a tax-efficient account, automate my monthly contributions, and then forget about it. My energy goes into building my career and skills, areas I can actually control. Investing is just the engine that compounds those results over time. So as you step into 2024, don't stress about finding the next Tesla or timing the market perfectly. Keep it simple, automate your investments, stay consistent, and let time do the heavy lifting. You're already ahead just by getting started. The best strategy isn't the most complex, it's the one you'll actually stick with.